Good morning and welcome to today's live technical analysis session. So, before we get started on with the technicals, we need to discuss what happened over the weekend and in particular Friday. So, on Friday, following the release of the US employment data, there are widespread concerns about a potential recession in the US economy, which could spill over to the global markets. As such, we're seeing a huge sell-off in the US equities. So, the S&P, Nasdaq, and Dow Jones are all moving lower. I'll show you the charts as we discuss them so that it's easier for you to visualize. So this is a daily chart. You can see that for the past 4 days, it is moving lower and lower and lower. Now, for the Nasdaq, we did get a heads up, and you can see that from the technicals that we had placed on a weekly basis. So we had discussed this particular bearish candle, and we did say that if it closed as it was, so touching on S1, would maintain a bearish outlook. So from a technical point of view, we did have a heads up for the downwards movement of the Nasdaq. Now, this much I personally did not expect. So essentially, what's going on is the higher than expected unemployment rate, so at 4.3%, has taken the markets by surprise. Now, and there's also talks about the unwinding of the curry trade. Essentially, people selling and cash is king. Essentially, that's it. Cash is king. Therefore, we're seeing a widespread sell-off in U.S. equities and overall in the markets. Now, what has this resulted in? It has resulted in the Nasdaq touching close or moving close to our support level at S3 of 17,183. So that is one particular impact. If you look at the FTSE, is moving very very low. It's broken below our S1 level of 8,140, broken currently below our S2 7,992, and is currently moving towards 7,819, which is our S3 support level. Now, for the FTSE in particular, we are noting Chancellor Reeves as well, potentially increasing the capital gains tax. Now, it's what we had discussed in our special edition video for the UK elections. Now, the Labour government has promised a lot, but didn't really show us how we were going to find the money. That now appears to be essentially increasing capital gains tax. I would not be surprised to see an income tax being increased later on in the year. But for now, that's the capital gains tax. So for me, the FTSE is not that appealing currently. Now, that being said as well, Euro USD, you can see that it has formed a new higher high, so swinging high just above our R3 resistance level at 1.0980. It is now finding support on our R2 resistance turn to support level 1.0915. Overall, we're seeing the greenback weaken. Before we move on to that, we also have the geopolitical risks. So that is gold. We're going to be discussing Google, which was found to have a monopoly over the search engine, according to a DOJ lawsuit upon which a judge ruled yesterday in favor of the Department of Justice in the US, which could weigh the company's stock price. Intel is moving lower and lower and lower, and that could be in particular to the release of the chips that were announced, if I'm not mistaken, about a month ago. There appears to be some issues. They're extending the warranty about 50%, according to a particular individual, which I can't seem to remember his name. Essentially, faulty chips, bad for the company, and it was their next gen as well. So that's a bit of an issue for Intel's stock price. You can see that it's moved from $30 per share to 20. So that is a bit of an issue. Microsoft also moving lower, Nvidia moving lower, ExxonMobil also moving lower. So oil prices appear to have been moving lower as well. Essentially, widespread sell-off in the markets. So not bad for Tesla on a daily chart. McDonald's, right? Essentially, we've seen a lot being wiped from the equities, and we're also going to be looking at the Nike as well. If I can find it on our charts, I'm not mistaken, Aussie Chinese. It moved 13% yesterday, dropped like a stone. So that is a bit of an issue. Japanese, yep. So this take. See. So we're going to. Ouch. So we are going to be doing technicals for a lot of pairs today and indexes. So we're going to be starting off with the euro against the US dollar. Now, Germany's factory orders rate, so financial release earlier on today, came in much better than expected. We have some support for the euro against the US dollar. So what we're going to be doing is technicals for the euro. I will be clearing our chart and we can place them again from the beginning. All right. So we are on the 4 hour time frame. Looking at the euro against the US dollar, I have my RSI indicator, which is at 54% as we're talking currently, and it is at the bottom left of your screen. Now, having dropped from above 70 to 50 implies that the bullish momentum may be fading away. As such, could be attributed to the strengthening of the US dollar, potentially. Now, for the US dollar, we also need to discuss that there have been a lot of speculation about a potential Fed emergency meeting in the upcoming week, in which a lot of people are expecting them to cut interest rates. Now, if you ask me, I don't think that's going to happen. The market expectations are for a Fed cut in September, and as such, it doesn't really make sense to see an emergency meeting by the Fed in the upcoming week. I think they're just going to wait for the September meeting and potentially cut by 50 basis points. So, Euro USD, I've seen a new high being formed. As we said before, this is our S1 support level, 0.1.09147. So that is currently S1 being tested as we're talking now. S2, I'm seeing price action here. If we can combine this with a prior high as well, high and then another prior high, price action finding support. So 1.08409, that is my S2. And then taking this low here, 1.0777. So I have my support levels. I would currently maintain a bearish outlook for the particular pair, looking at the 4 hour chart. If it breaks below S1, if it breaks below S1, it could seek liquidity and support at our S2 level at 1.08409. Overall, I've seen a high. I want to see a new higher low being formed, and with this price action here on the 4 hour, I don't see that occurring just yet. So for now, I would be maintaining a bearish outlook for the particular pair. My resistance is where the bullish and bearish candle opened and closed respectively. So roughly at 1.099910. That would be my R1. I now need to find my R2 resistance line. So I need to go back and see where another resistance level was. So we're moving back and back and back. Let's see. So resistance. So we've left 100 pips between our support levels. So this is a nice sell area, 1.0, 1.1063. Then we can take this high as R3. Equidistant between themselves, imitates as well our support levels, valid support and resistance levels. And now we need to adjust. Essentially, it's not 1.099096, it's 1.0990. That is R1. And I need to change the text labels as well. So that is my R1. For my R2, it will be at 1.1065. So that is my R2 resistance line. Essentially rounding it up or down to the nearest interval. So 5. So if it's 1.064, 1.065. Psychological impact of round figures as well. So this becomes 1.1140. That is my R3 resistance level. When talking about gold and oil, which we will do in a few moments, what you need to remember is that it is also the geopolitical risks that still persist in the Middle East. So that is still an issue. So if we are seeing it moving in a downwards fashion or in a relatively sideways bias, it might only be temporary. Personally, I have been seeing the buildup of strategic military forces within the region. So US naval carriers, strike groups, army personnel, US Marines. We're seeing talks about Iran, potential escalations. So those continue to be an issue. 1.0777 for my S3 support line. So currently moving in a downwards fashion, but it needs to break below S1. If it fails to do so, sideways bias between S1 and R1. And if it manages to break above R1, maintaining a bullish outlook up until R2 at 1.1065. USGJPY has broken below S1, S2, and S3. GPUSD has broken below S1, taking aim for S2 at 1.610. And then Aussie. So for the Aussie, the RBA remained on hold as was expected. Now it did dip below and touched on our S2 support level, which we had placed. So that's nice. It's a validation of S2 at 0.6360. Now, the interesting story with the RBA is that they did discuss a potential rate hike. And as such, it is a hawkish pause, which might provide some support for the Aussie. The issue with the Aussie is that concern surrounding China's economic resilience still persists, and as such, may have capped or minimized the losses the Aussie may be facing from a weakening Chinese economy. But it's still and has moved back into our S1 and R1 level. So we are keeping our support and resistance levels the same. S2 as well, as it has validated support at 0.6360. But we are maintaining a bearish outlook for the particular pair as long as it closes below S1. Now, the more interesting story will be the Nasdaq Dow Jones, and we should start off with the Nasdaq. So this is the Nasdaq index. We are using the weekly time frame. We could use the daily as well. It does make a difference. But still, so we had our hypothetical resistance levels. This is now removed. Our support now turns to resistance, and I will be adding the text labels as I can see you. The pricing and the values on the right side of your screen are currently obscured, so we will be adding these text labels, make it easier for you to follow along. So this is R2. R3 will be the all-time high figure at 2,960. So this will be our R3 resistance level. I'm not seeing any major financial releases that are set to be released today. So I think it's going to be predominantly, so the market's movement might be predominantly dictated by potential Fed speakers or reports coming out about the status of the financial markets or potential rate cuts by the Fed. It's essentially very, very, very volatile. And if they do move in an upwards fashion today, it might be a retracement as they have moved significantly lower during yesterday's trading session. So you might be seeing people exiting their short positions, might allow for a retracement of the index back up to R1, 18,600. RS1 support level will remain at 17,200. So that is my S1 support level. From the technicals, it hasn't broken our S1 level just yet, but it did break S2 and S3. So we are maintaining a bearish outlook for the index, given that the RSI is also dipping below 50, implying a switch from a bullish towards a bearish market sentiment. S2 for me will be taking this all high, price actions, finding support. So 15,000, I think, is my S2 support level. But if I'm placing it at 15,000, then I can place it either higher or lower. Right. So given that I'm placing my resistance levels fairly close to each other, so this was an all-time high figure, but this might be resistance now. I will be keeping my S1, S2, and S3 support levels fairly close to one another. Although in an ideal world, I would like to have it a bit further apart. But still, valid support levels. S2, 15,775. That is my S2. S3 is 14,270. So that is what I will be placing for S3. We are still concerned about the movement of the indexes. So, from a technical point of view, the talks about a recession, I am concerned that the Fed may need to cut interest rates soon, but I'm more concerned about them cutting them earlier than they need to. 4.1 to 4.3 isn't that bad. If you look at the financial releases stemming from January to March and even April, the US employment market was very tight. But the markets moved higher and simply reduced their expectations of rate cuts. But they moved higher. So why are they reacting to this now? It's more of an overreaction. They're scared. They've all positioned themselves for it to move higher and higher and higher. They were expecting unemployment to stay the same, the Fed to cut rates in September, and they have to readjust essentially. But I still think it's an overreaction. I think the Fed might cut once or twice, maybe 50 basis points in September. If we see Fed policymakers coming out and speaking, I think it's going to be more of a dovish tone to reassure market participants. And I don't think there's going to be an emergency rate cut by the Fed in a week's time. It simply doesn't make sense. There's no point. If you cut by 50 or 25 basis points in September, then why are you going to cut in 1 week's time? Like, you can just simply wait for that meeting to occur. There's no reason. I think from a communication perspective, they're going to signal more that they're going to cut rates to reassure market participants, and that could essentially see an unwinding of this downwards movement. But from a technical point of view, we are maintaining a bearish outlook as long as it breaks below S1. And then target is S2, 15,775. So that is the Nasdaq. We are going to be doing the S&P 500. So these are support turn to resistance levels. And this remains support. So our S2, which it was S3, has been validated. Note note the wick of the bearish candle that occurred during yesterday's trading session. Nicely, beautifully, perfectly touching on S2 now, 5,150. So validating our support level, which we had placed together last week as well. And look at our newest one, 5,235, which is now upon which the price action is finding support. Note this daily candle. We drop down to the 4 hour. Support broke. Support might stay between S1 and R1 today. These are support and resistance levels that we had placed last week before the US employment data. And this is why I prefer, and for me to switch or maintain my outlook, it needs to form a clear break and close below a support or resistance level. Otherwise, we would have maintained a bearish outlook here. But look, it wicked up. It closed and is now resting on S1. So it is a bearish outlook for me for 30. But for it to continue, it needs to close below S1, 5,235. If it does not move below S1, so if today's daily chart does not close below S1, I would switch perhaps for a sideways bias between S1 and R1. Simple as that. It needs to close below. If it doesn't, for me, that means there might be seeing significant buying pressure and could maintain it between S1 and R1. Nonetheless, if it does move above R1, target for the bulls is 5,249, which is my R2 resistance level. And then S3 becomes 4,960. So this is the S&P 500 on a daily chart. Feel free to take a screenshot and simply just see how the price action respects our support and resistance levels if we are correct. Dow Jones, not looking that good. Imitating the S&P 500, bearish outlook. Oil prices moving in a downwards fashion. 71.40 is RS2 support level. Note it broke below S1, so we were correct. Broke below and moved down towards S2, found support and moved higher. Once again, validating the support level that we had placed together last week. If you look at last week's live technical analysis session on Thursday, we had placed this together. We neglected this as we had seen support at this point and had decided together that this was too close to our support level for it to be placed. It did find support, yes, but this was more significant, which is what we had discussed in our live technical analysis session last week, and in particular on Thursday, if I'm not mistaken. Now, this support level now becomes resistance 74.5, 74.75 is my new R1 resistance line. So this is resistance. I am still maintaining a bearish outlook from a technical point of view. The RSI is at 30. It has broken below my support, now turned to resistance level. The issue I have with gold and oil is the risk of a war between Israel and Iran. That is still a concern. And if we see an escalation, potentially the firing of missiles from Iran or Hezbollah towards Israel and Tel Aviv, that could support oil prices and gold. So we are bearish, but a bit skeptical as to how long this bearish momentum may be sustained. Now, if we don't see a retaliation by Iran, then yes, I would maintain a clear-cut bearish outlook for the commodity, particular oil and the precious metal. But personally, I think we might see a retaliation, and as such, my bearish outlook is only temporary. Now we are going to be placing our new S3 support level. I'm taking this wick here, close to this one as well. Heavy buying pressure, not how it bounced up. So that would be my S3, and that is 64.10. I'm going to be doing gold and will be ending today's technical analysis session. I will be seeing you all tomorrow. So we'll talk about any developments. Uh, mm, I do want to look at Microsoft as well. So we'll look at gold and Microsoft because Microsoft is very interesting. I was looking at it before we started our live. What we had seen last week appears to have been validated. So these are the support and resistance level for oil. Bearish outlook as long as it breaks below S1. Target for the bears is 67.90. And a quick look at gold. So staying, need to readjust this. 2,390, 90 maybe, 92. 2,392 as our S1 level, S2 and S3 remain the same. Just simply readjusting S1. Maintaining a relatively sideways bias, staying between S1 and R1. So our support level should have been slightly lower. Note the RSI is moving closer and closer to 50. Narrowing of the Bollinger Bands. Now, the chart we released earlier on today with our key points had R1 higher, and that is still valid as well. We are looking at the 4 hour. So R1 at 2,432 still valid for me. As long as it stays between S1 and R1, sideways bias, breaks above R1, aim for R2, 2,483, and then hypothetical resistance at 2,530. If we see a retaliation by Iran, could easily break above R1 and R2 within perhaps 8 hours. So 2 4 hour candles, that could break. If we don't see retaliation, could move in a relatively downwards fashion. Target for the bears S1 2,392. Target for S2 is 2,350. And now we will be looking at Microsoft. So this is the chart that we had done together last week. We had put an upwards moving trend line. We noted upon which the on-balance volume had begun rising. So this was higher highs, higher lows, etc., retracement. People taking profits and moving higher coincided with the upwards moving trend line. We had noted last week this double top and double bottom. We said that this was in particular very, very concerning. Why? We weren't sure as to where it was going. And where we were looking at this, if I'm mistaken, so it was on the 30th, we had placed our S1 support level. Note upon which it has broken S1 409.20. On balance volume has broken below. We are maintaining a bearish outlook for Microsoft stock price. It's broken below an upward swing trend line. Bullish bands appear to be tilting towards the downside, implying a bearish market sentiment. It's broken also below S1. So next target is S2. And I'm just realizing that you can't really see that. So let me just readjust the text labels that we have. So this is R3, 490, R2, 468, S1, which is now resistance, 409.20. And look at support. It's close and almost validated completely. support at 383.55. I am keeping this support level though. I'm not going to be changing this. I think support is at 383.55. And then S2, 359.70. I'll change this real quick. So this is R1. I am maintaining a bearish outlook for the reasons I mentioned before. RSI on balance volume breaking below, finding support near RS1 level, but I am keeping RS1 level. This becomes R2, R3, and R4. So this becomes S1. This becomes S2. Finding support and moving higher. Finding support, broken below, acting as resistance, pierced through, but still came back up, bounced off, found support, acted as a resistance once again, broke above, acted as support. 325 big figure is my S3 level. I'll be removing that 308. So my S3 is 325. And I think that does it for today. So essentially, we're seeing a sell-off occurring. Will not be surprised to see this continuing for the rest of the week before the markets readjust. And because I personally believe that it is overdone and it's simply put an over exaggeration. They're overreacting to that release. They're hoping for an emergency rate cut by the Fed. That's not going to happen. I don't see that occurring. Might be a bit bad for the next few days, but I wouldn't be surprised to see them recouping some of their losses, perhaps with a rate cut in September if the Fed cuts by 50 basis points. So it might be bad for the next week or so. But from a more macro perspective, they're still overreacting. I still believe there's going to be one rate cut, and I think the Fed is prudent in essentially taking their time. There's no reason to undo the progress you've done on inflation, only for you to have to hike later down the line. That's pointless. Keep interest rates steady, perhaps for another month. Perhaps you could cut rates in November and cut them by 50 basis points. Keep on hold in November, September. But with what we're seeing, I think the Fed may not have an option and will have to cut by the September meeting by 50 basis points. And if that happens, we could see the stock prices recouping some of their losses they're going to be making. So August might be a bad month for investors, but overall, I think the markets are overreacting. Nonetheless, I am still concerned about the resilience of the US economy, but I don't think the recent financial release warrants such a reaction in the US equities and overall in the markets. The issue we do have is Google, which was found guilty, so that could weigh on their stock price as well. Found to have a monopoly over search engines. That was a case that was judged yesterday. That was a verdict, so we'll have to see how that develops as well. But overall, from a technical point of view, we are maintaining a bearish outlook for the company stock price. And with that, that does it for today. I'll see you all tomorrow. Same time, same place. Take care.
as per usual, before we get started, just a risk warning. So, our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer: the information in this webinar should not be construed as investment advice or an investment recommendation, but instead educational material only. This material is just a personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of material is strictly prohibited. So I'm Melanie. I'm an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. And today we're going to be talking about IC trading. IC trading, yeah. So this is a trading strategy that is pretty unique. So here's our agenda for today. We'll talk about what exactly it is and then get into some of the key concepts, followed by understanding what exactly it is and how you can make use of it. And then we'll look at what smart money looks like in price action. So if you guys have any questions throughout the webinar, feel free to pop a question into the chat and I will be happy to answer them. Okay, let's go ahead and get started. So what is ICT? So basically ICT stands for inner circle trading. Okay, let me just allow you to pop your questions into the chat. Okay, so let's start by defining what exactly we mean by inner circle trading. So ICT, or inner circle trading, is a trading methodology that focuses on understanding the inner workings of the financial markets. So it involves analyzing market dynamics, identifying supply and demand zones, and utilizing price action analysis to make informed trading decisions. So it has now grown to become one of the most popular trading strategies around, focusing instead solely on price action. And it was originally created by Michael Huddleston to trade the Forex market, but currently traders are using the same strategies to make profit in all and any market that they trade. So, yeah. So why exactly is it important for us to understand what ICT is? So in today's highly volatile and competitive financial markets, having a deep understanding of how the markets operate can give you a significant edge as traders. So by mastering the ICT techniques, you can enhance your ability to identify high probability trading opportunities and effectively manage your risk. So what exactly it is basically employing chart technical analysis and operates under the premise that by studying price movements, support and resistance levels, and order blocks, one can to some extent pinpoint the areas with the highest liquidity concentration and consequently forecast emerging trends. Okay, so let's get into some of the key concepts. Okay, so firstly, for our key concepts, we'll go through liquidity, followed by displacement, market structure shift, inducement, fair value gap, optimal trade entry, and lastly, balance price range or order block. So these are the fundamentals that you need to know in order to take advantage of trading in this style. So firstly, first key concept we'll go through is liquidity. So there are basically two types of liquidity. There's the buy side and sell side. So firstly, buy side liquidity represents a level on the chart where short sellers will have their stops positioned. So sell side liquidity is just the opposite of that. So it represents a level on the chart where long biased traders will place their stops. In both cases, these levels are found at or near extremes, as the tops and bottoms of ranges are often viewed where traders are proven wrong and therefore will want to get out of their trades. So here's an example. So smart money players understand the nature of this concept and commonly will accumulate or distribute positions near levels where many stops reside. So you can see here, our sell side is on the bottom where the swing lows are. Buy side is where the swing highs are. So basically, it's where your resistance and your support levels are. So it is in part the sheer amount of stops at key levels, like those that I've just identified on this chart, that allow a larger player to fully realize their position. So once the level at which many stops are placed has been traded through, it's often that the price will reverse course and head in the opposite direction, seeking liquidity at the opposite extreme. Okay, so you can see normally at these resistance levels, you would expect price to reverse off of these levels. Similarly, for your support levels, you would expect price to bounce off of those levels as well. So that's just basically what we are trying to say over here. Okay, next, let's look at displacement. So displacement in short is a very powerful move in price action, resulting in strong selling or buying pressure. Generally speaking, displacement will appear as a single or a group of candles that are all positioned in the same direction. These candles typically have large real bodies, so you can see in the image here, your strong selling pressure would look like these candlesticks here, which have large real bodies, very short wicks, like you can see here, and that kind of suggests that there is very little disagreement between buyers and sellers. And if we are looking at strong buying pressure, like the one we see over here, similarly, you see that the body of a candlestick is long, whereas the candle wicks are pretty short. So a displacement will normally occur just after a liquidity level has been breached and will often result in the creation of both a fair value gap and a market structure shift. So we'll get into what those mean in a little bit. But basically what it means when we say a displacement occurs after a liquidity level has been breached is if you look at this area here, this is a multiple swing low support level. You can see price has recently broke out of that level. If you can imagine this horizontal line just over here. So it's broken out of it and is reversing off it now. And that is what is resulting in a strong buying pressure. So that's just basically what it means by a liquidity level has been breached. So if you think about it as what we've been going through normally, which is through your support and resistance levels, it's pretty easy to catch. But let me know if you guys have any questions so far. Okay, if not, let's move on to the next key concept, which is a market structure shift. So there are two major market structure shifts. It's just another way of saying it's a trend. So we have an uptrend, which is when the price is making higher highs and higher lows, and a downtrend in which the price is making lower highs and lower lows. So it's pretty straightforward, but if we are referring to something that we talked about previously, um, you can see in this example, we have swing lows. Yeah. So these sessions are recorded. I think they will be uploaded onto YouTube, but I'm not too sure. You can email IronFX. I think the email is on their website. So let me just check. But yeah, you should, if you email them, I think they will be able to send you the recording, or at least give you the link to the right place. Let me see if I can find the email. Okay, I think if you go onto the ironfx.com website, you can just email them over here, support@ironfx.com. And I think they'll probably send you the link to this recording. Okay, sure, no worries. Okay, so where were we? Yeah, so when you're looking at market structure shift, it's important to find a market structure that has very clear movements in price. So if you look at the GIF that I've included here, there's a very clear price movement with swing highs and lows that are really significant. Okay, another example would be of a clear market structure. This isn't. Oh, let me go back to my slides. Okay, so this is the GIF that I was talking about earlier. So you can see that there are very clear movements in price with clear swing highs and very clear swing lows as well. If we look at this market structure, it's not as clear, but you can see that it's a very clear downtrend. So that's just basically what we're looking for over here. Okay, but typically we recommend you to look for a market structure that's clearer, something like this. Um, yeah, or something like this as well. So it doesn't have to follow a trend line. So over here you see that we have four um four swing highs that line up on this trend line. And it doesn't have to line up on a trend line. I'm just using this picture to show you what you can look out for. So here you see that we have um higher lows, or rather lower highs, since it's a downtrend. Okay, so next key concept we're looking at is the inducement. So rarely does the price move in a straight line. So within a larger trend, there are almost always counter trend moves. These counter trend moves are the results of lower time frame liquidity hunting. So let me show you an example. So if you see in this example where we have identified the market structure shift, it's basically when price has broken below this swing low. Okay, so that's a market structure shift. The inducement is when price has bounced off, which is over here, bounced off and is reversing off of a new resistance level. Okay, so the price will bounce or get rejected and then will target a previous short-term high or low before continuing in the same direction as the longer-term trend. So the short-term high in this case is here, all of the circles over here. Okay, and then it continues in the same direction. In this case, it's a downtrend in the longer term. So, yeah. So inducement is specifically targeting these short-term highs, like those that we've circled, or short-term highs or lows as areas where these stops might be placed. So because you're expecting price to reverse off of these circles, you might decide to place your stop loss right above these levels here. Okay. Okay, now next key concept we're looking at is the fair value gaps. So these are created within the displacement, and are defined as instances in which there are inefficiencies or imbalances in the market. So if we visualize what this means, it's basically a three-candle sequence containing one large middle candle whose bordering candles, upper and lower wicks, do not overlap. So let me show you an example of this now. Okay, so if we look at the fair value gaps that have been filled, okay, you can see that these, if you follow the arrows, right, the fair value gaps are basically the levels in which price has retraced and is testing that level again. So it's basically what we previously mentioned as um, overlap resistance or support levels, or in this case, it's support overlap areas. Okay, so you see price reversing, testing that level, bouncing off of it. Similarly, price reverses, tested that level, and reversed off of it. And same thing over here. So in the example that I have here, the fair value gaps that are unfilled are basically the levels that don't reach that same level or the same areas from the previous price. Okay, I hope that makes sense, but you can just look at the chart, the example that I have here. Okay, so maybe to start off, you can look for what we've mentioned in the previous slide, which is the three candle sequence containing one large middle candle whose bordering candles upper and lower wicks do not overlap. So you can look for some of those examples in over here. Okay, so next let's look at optimal trade entry. So the optimal trade entry represents the best places to get into a trade, and they can be identified by utilizing the Fibonacci between 61.8 and 78.6. So maybe I'll show you an example. Our previous webinars recently were on Fibonacci, but if you missed that, I'll just briefly go through it here. Let me just pull out my, let me just show you guys a website. Okay, so if you missed our Fibonacci series, not to worry because we'll probably go through that again. But because we recently finished that, so it might be a while. But anyway, so the website that we recommend you to go through is theforexarmy.com, and it goes through how exactly to draw a Fibonacci retracement correctly. So there are some videos that you can take note of, the market structure to keep an eye out for. Okay, so if you're looking at using the ICT to find an optimal trade entry, they recommend to use a Fibonacci between 61.8 and 78.6. So although we typically use these levels, you would just be looking at these two levels here. And how that works is basically by looking at the highest starting point to the lowest, okay, or like something here. Shows you the invalid as well. Yeah, but you can just go ahead to this website and take a look. Okay, I think I'll just pop it into the chat. Oh, we have a question. Okay, what happens to FVG that has not been filled? So if we go back to my slides, basically what it means when it's not filled is that we don't expect price to return back to that area anytime soon. So we are not going to use those levels as, um, we're not going to take note of those levels. We want to take note of these FVGs that have been filled in order to place your stop losses and your take profit levels, yeah, according to those levels. Okay. I'll show you guys on TradingView, there is an indicator that helps you to find FVGs. So it's probably the easiest way to spot those, but I'll show you in a little bit. Okay. Yeah, I was talking about optimal trade entry. So the link that I've popped into the chat basically goes through the fundamentals of how to draw a Fibonacci, which I'll briefly go through here as well. So this is a Fibonacci retracement checklist. So firstly, you want to see is the market structure clear? So we showed you previously how to identify a clear market structure. Next, we want to look for the recent trend, so our prices going up or down, and it's important to always follow the general trend. Next, we want to identify recent major swing lows and swing highs, like those that we've identified previously, and then connect the two extreme points like we have done over here. So since this is a downtrend, your starting point is at the swing high and your ending point is at the lowest swing low. Okay, here you can see all the different Fibonacci numbers that we mentioned in the previous slide. So for the ICT, we are focusing on 61.8 and 78.6. Okay, but it's basically the same thing. Here's another example. So we are looking at the level at which price bounces off either your 61.8 level or your 78.6 level. Okay, now let me get back to my... Okay, so after optimal trade entry, the next key concept is a balanced price range or imbalance. And this is the result of an aggressive move up that's immediately followed by an aggressive move down, or an aggressive move down that's immediately followed by an aggressive move up. For an uptrend, do we start the Fib 0 at the bottom or the top? Okay, I'll show you in a bit. Do I have it here? Yeah, so like something like over here, we would draw it, your starting point here, and then your ending point would be here. So your 0% would be at the top. Okay, yeah, balanced price range. So what's left after either of these instances is essentially a double FVG or fair value gap, which can act as a magnet to the price before a continuation move higher or lower. So balanced price ranges can sometimes signal the beginning of a market structure shift, and the price can often retest and reject from those areas. Okay, so now let's look at what smart money looks like in price action. So SMC trading involves looking at order blocks, which is a refined version of supply and demand of an asset, and then your breaker block or mitigation blocks. This is what is traditionally called your support and resistance. flip zones, and then your FVGs, which are imbalances on the market. So when demand outpaces supply or vice versa. And then lastly, your liquidity gaps, which we went through before, are basically the areas in which um, there is a support level or a resistance level. Okay, now let me pull out my charts. Okay, so if we are looking at DXY, just a random chart, how you basically implement the FVG indicator, okay, is okay, you go to the indicators, search for fair value gap, and this one. Okay, so this helps you to identify any of the FVGs. Okay, and you can use this on any time frame as well. So I'm on the 1 hour time frame now. Okay. Yeah. So the one that we use is the Luxel Gold one. This one here. This one. Lux Algo. So this automatically helps you to find FVG on any time frame, and it will help you to highlight the level as well. Okay. Okay, so you can actually use um these key concepts more as like a checklist when you're using the ICT trading strategy. So firstly, you look for the liquidity, followed by the displacement, look for any market structure shifts, inducements, value gaps, and then use your Fibonacci levels to find your optimal trade entry, followed by the balanced price range, which is basically looking for a double fair value gap over here. Okay, let's look at this example maybe. Okay, if I can find a double fair value gap, I'll show you as an example. But one of the websites we used, okay, let me just share that website with you. Because this is quite a niche trading strategy. So I'm just gonna share all the resources that we use. Um, So basically what I mean by a double fair value gap, so you can look at this website as well. But basically this is what we are looking at. Okay, so we have a balanced price range up here, which is essentially where price rebounds off of a resistance level. It drops and then it tests that level again. Here it says price testing and rejecting your BPR. Basically, if you were here for our support and resistance levels, we're just talking about a double swing high here. So it's just basically where the level is reversing off of that same level before, the same resistance level as before. Okay, and the reason why we are highlighting this entire area is because that's basically where we see price being attracted to. So it tends to be attracted to such areas and then reverses off of it. Okay, let me go back here. Okay, if we go back to the, yeah, to my chart here. So you can see that our fair value gap is in this area here. Okay, we have this green highlighted area, which is in line with this swing high. If we look at this fair value gap highlighted here, this is in line with this resistance area here as well. Okay, so we're expecting price to continue to rebound off of this area, yeah, and drop below it. So that's for resistance levels. We're looking at support levels. Here we have a swing, a, a couple of swing lows that match up with swing highs. Okay, so this is one swing low, two swing lows, and then a swing high, right? So this is a pretty significant level, and using your fair value gap basically helps you to highlight any of such areas. So like I mentioned earlier, these are not really specific levels, they're more so areas. Okay, and if we use, let's see if we can make use of our Fibonacci levels as well. Okay, here we see that we have a nice 38.2 that lines up nicely with this area. Okay, if I look at our 61.8 as well as the 78.6, okay, you can see that that also lines up with the highlighted fair value gaps over here, okay, as well as the 78.6 doesn't really, apart from this swing low, it doesn't really match up, which is fine. It doesn't always have to match up. So you can see that this 61.8 is a pretty significant level here. Okay, the reason why I say it's significant is because we have one swing low, two, three, and four levels that are lining up. So we can expect price to be attracted to that area again and then bounce off of it. Okay. Yeah, I think that's all the time that we have for today. Again, so sorry for the delay because of the time mix up. Um, but yeah, let me know if you have any other questions. Um, yeah, for with regards to the recording, the email is on the IronFX website, and you can probably get the recording from them. And next week we will be going through the second part of this ICT series. So yeah, stay tuned for that. Yep, I think next week we will start the usual time. So there won't be any scheduling mix up again. Yeah, but so sorry about that. Thanks everyone. See you guys next week. Bye.